Hello, I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group. In a weekly briefing, as always, we bring you a slew of updates and outlook across the region to prepare you for the week. Suhaimi Ilias, Chief Economist, speaks to our analysts.
Hi, morning, everyone. It's Monday, 23rd May. Let's start with a quick run-through of what happened last week and what to expect this week. For last week, Wall Street lurched lower as consumer stocks like Target, Walmart, Lowe's, and Home Depot earnings were hit by higher supply cost and slower consumer spending, heightening worries of US hard landing or recession amid US Fed's aggressive policy tightening. At its low point on Friday, the S&P 500 index was down roughly 21% from its January intraday high, exceeding the 20% threshold for a bear market. With the hit to profit margins, major retailers may be forced to pass on more of their higher costs to consumers in coming months, keeping inflation elevated. And comments from Fed Chair Jerome Powell add to negative sentiment and interest rate fears. On Wednesday, for example, he told the Wall Street Journal that taming inflation is necessary and policymakers wouldn't hesitate to raise rates as much as necessary, even if it means some pain. US economic data, however, last week provided rather mixed signals whether recession is imminent. Retail sales, excluding the volatile auto segment, had risen more than expected in April, and March figure was revised upwards. Industrial production and capacity utilization figures last month also surprised on the upside, but the gauge on manufacturing activities in mid-Atlantic region fell short of expectation by a wide margin. Weekly jobless rate rose more than expected, and housing starts and existing home sales came in lower than expected, reflecting impact from higher mortgage rates. The US 10-year Treasury yield fell as low as 2.77% in intraday trading on Thursday, its lowest in nearly a month. In Europe, stocks actually declined, and bond yields came under upward pressure amid hawkish comment from several ECBs and Bank of England's officials amid resilient economy and rising inflation. EU's first quarter 2022 GDP picked up to 5.2% year-on-year from a 4.9% year-on-year in fourth Q last year. UK inflation rate hit 9% in April, the highest since 1982, while jobless rate over there fell to 3.7% in March. That's the lowest since 1974. EU announced a 300 billion euro plan called RE-Power EU that aims to end EU's dependence on Russian energy imports with other fossil fuels, boosting green energy and financing new pipelines and liquefied natural gas terminals. Japan's first quarter 2022 GDP remains sluggish at 0.2% year-on-year versus 0.4% year-on-year in fourth Q, justifying BOJ's continued ultra-easy monetary policy and also prompted the government to announce further easing in border controls. Meanwhile, People's Bank of China announced measures that aim to support the property sector through the cut in 5-year loan prime rate, or LPR, a reference for home mortgages, by an unexpectedly large 15 basis point to 4.45%, and also lowered the limit of mortgage rates for first-time home buyers. This is as economic data released last week point to slowing growth on lockdown effects, as per the lower than expected industrial productions, retail sales, and fixed asset investment, together with the 8th consecutive month of falling home prices as of April. In ASEAN, key developments last week include BSP's 25 basis point interest rate hike, Thailand's sluggish first quarter 2022 GDP, and a mixed bag of its external trade stats for Singapore and commodity exporters like Indonesia and Malaysia. Things to watch this week include Singapore April CPI today, Bank Indonesia's monetary policy meet tomorrow, as well as flash PMIs for the month of May for major economies like EU, US, and Eurozone. So this morning we have Hak Bin, Joey, and Zamros on Singapore, Thailand, Indonesia, and Philippines macro. From Equity Research, Willie, Chee Ting, and Sevidal will brief us on Indonesia's consumers, regional plantation, and Philippines property sectors in the wake of India's wheat export ban, lifting of Indonesia's palm oil export ban, and Philippines election, plus update from Jean on Sea Limited. And last but not least, Andy is also on air today to talk about FX, especially on current weakness in Renminbi. Let's start with Hak Bin. Hak Bin, Singapore's non-oil domestic export growth on a downtrend and now on slowing double-digit expansion since February this year. Not being commodity exporter is a factor, given sustained double-digit export growth of commodity exporters like Indonesia and Malaysia. But what other factors are causing the slowdown?
Hey, hi, morning. Export growth slowed to an 8-month low in April, just 6.4%. That's down from the 7.7% in March. And I think part of it is also due to the exports to China and Hong Kong, which contracted due to lockdowns and supply disruptions. When you break it down, the electronics was holding up a bit better, and most of the slowdown was in the non-electronics side. But I think important message to bear in mind is that exports are actually driven and flattered by higher prices rather than volumes. So actually, when you look at real exports, real NODX, it actually contracted for the third consecutive month, roughly by about 4% in April. So I think that's evidence that the global headwinds, from the global slowdown, the supply disruptions, and our rising interest rates, is dampening the reopening tailwind. The other part of the data that's interesting is actually the exports to ASEAN. So that's a bright spot. And I think you can see the impact on the reopening here. Very robust NODX growth to Malaysia, up 20%, Indonesia, 21%, Thailand, 21% as well. So for the full year, we're maintaining our NODX forecast at 4 to 6%. That's down from 12% last year. But again, we think the outlook for global trade is clouded by emerging headwinds, including the war, the China lockdowns, and global monetary tightening. GDP Singapore will be released on Wednesday this week. The finalized 1Q GDP, and we're expecting the government to downgrade the current forecast from the 3 to 5% to 2 to 4%. So our forecast currently is at 2.8%, slightly below the current official forecast.
Hak Bin, briefly, how's the domestic demand outlook given the situation with export or external trade right now?
The domestic demand should be picking up with the reopening. I think we're going to see some, fairly encouraging, F&B, retail sales, aviation, hospitality, all the sectors that lag behind the recovery. That's going to get a boost. But I probably would not overstate that part to outweigh, the impact from the slowing global trade side. Singapore is a very open economy. Exports is 300% of GDP, and just bear in mind that the retail trade is only less than 3% of GDP. Tourism is actually around just 5-6%. So there is a recovery there that's going to help the struggling sectors, but it's not going to be enough to offset. The other point is also that when you open borders, it cuts both ways. More Singaporeans traveling abroad could also reduce summer consumption at home. So there is a bit of a switching there.
Thanks, Hak Bin. Jui, just want to talk to you about Thailand and Indonesia's macro, but let's start with Thailand first. The first quarter GDP picked up, but 2.2% year-on-year from 1.8% year-on-year in the fourth Q last year, grossly underperformed ASEAN peers, given 5% year-on-year growth in Indonesia, Malaysia, Vietnam, and slightly over 8% growth in Philippines. I guess the question is, why is Thailand such a laggard?
Hi, morning Suhaimi, morning everyone. So Thailand's first quarter GDP is still around 2.4% below pre-pandemic levels. And that's because services exports, which refers to tourism, are still around 64% below pre-pandemic levels. Following the end of compulsory PCR testing on the 1st of May, tourists are returning on a larger scale. The monthly estimate for June bookings exceeded 1 million for the first time in 2 years. And that has prompted the Tourism Authority of Thailand to raise its tourist arrivals estimate to at least 8 million this year from the earlier 5 million. Having said that, normalization to pre-COVID levels, where the tourist arrivals reached 40 million in 2019, will not be possible given the absence of China tourists, which accounted for almost 28% of total visitor arrivals prior to the pandemic because of the zero COVID policy. We are maintaining our Thailand 2022 GDP growth forecast at 3.2%, given that the growth outlook is clouded by the prolonged Russia-Ukraine war, China's lockdowns, and global monetary tightening that could dampen the recovery in the second half of the year. Surging inflation in Thailand, where headline CPI is at around 5%, will also weigh on private consumption. We have seen consumer confidence index dip in April to an 8-month low, to levels last seen during the Delta wave.
Can you remind us what's BOT stands on the monetary policy right now, the outlook?
Yeah, sure. So BOT has kind of emphasized that they are, given that the inflation shock is really largely driven by energy prices, they do want to keep monetary policy accommodative until economic growth is actually on a firmer footing. But I think, in my view, BOT would have to start normalizing perhaps in the third quarter, given that regional central banks have already trying to catch up with the Fed. And also the baht has been underperforming the other ASEAN currencies. So we are looking at a 25 bips hike in sometime in the third quarter.
Okay, on Indonesia, April numbers showed a mixed bag of record high exports, easing in imports, and an expected drop in retail sales. You expect BI to join BNM and BSP in starting raising interest rates this week. Can you remind us again the House view on Bank Indonesia's monetary policy outlook, number one, and number two, what about the government's fiscal policy stance?
Sure. So BI is meeting tomorrow. We are looking at BI to raise its policy rate for the first time since the pandemic by 25 bips, following the Fed's 50 bips hike earlier this month. Given that domestic demand is back above pre-pandemic levels as of the first quarter, and inflation has been picking up. In April, it came in at a 5-year high of 3.5%. The rupiah has also weakened in recent weeks to its lowest level in almost 2 years because of the impact of the palm oil export ban, as well as the widening rate differential against the Fed. We are currently penciling in a total of 75 bips hike this year, although risks on the upside as the Fed turns more aggressive. On the fiscal policy stance, the Finance Ministry has recently proposed to significantly raise the budget for energy subsidies and compensation to state-owned energy firms, Pertamina and PLN. So the proposed increase is by nearly 290 trillion rupiah to 443 trillion rupiah. That's equivalent to around 2.5% of GDP. And that's really to prevent the hike in subsidized fuel prices. The finance minister has stated that this increase will not prevent the fiscal consolidation timeline of bringing back the budget deficit to below 3% of GDP next year. And that's because state revenue is expected to come in around 420 trillion rupiah higher than the original assumption. So this could be used to offset the increase in subsidies. The government is also aiming to slash its debt issuance by at least 80 trillion rupiah this year. And that would bring budget deficit of 2022 to 4.5% of GDP. That's still lower than the initially planned 4.85% of GDP, but it is wider than the guidance provided by Finance Minister before the Russia-Ukraine war, which was closer to around 4% of GDP.
Right. Thanks, Jui. Still on Indonesia, this time we move to consumer sectors. Willie, on India's wheat export ban, will this be problematic to Indonesia's companies procuring wheat from the global market? Which companies in your coverage will be most affected, and are they able to pass through any cost increase from the supply disruptions and the need for substitutions?
Okay, good morning, Suhaimi and everyone. In our view, the impacts of India wheat export ban on domestic wheat procurement for our consumer companies should be less of a concern. While India is one of the world's major wheat producer, our consumer names use wheat from Australia, US, and Canada. And based on the Food Security and Peace Index, we think these countries are less likely to have export bans. Meanwhile, we think India's wheat export ban will cause prices to remain elevated. Indofood CBP is likely to be most affected, as 71% of its total sales are related to the use of wheat for its noodle products. This is followed by Mayora Indah, which derives 57% of its total sales from wheat-based food products. ICBP and Mayora should be able to reduce cost pressures by raising their ASP. Our calculations suggest that these companies will have to raise their average selling price by 1.9% and 2.3%. And we think that Indofood CBP has stronger pricing power than Mayora. Our observations suggest that ICBP noodle sales volume still grew in 2013, 2014, despite a steep selling price increase of 9% and it was 16% back then at the time. We think this is due to the fact that Indofood CBP noodle products are perceived as staples for its buyer. Second one, these products have low pricing points. And third one is that these products maintain market leadership.
Thanks, Willie. I'm going to bring in Chee Ting into the conversation now. Chee Ting, as India imposed export ban on wheat, Indonesia, in contrast, is lifting the export ban on palm oil, I think today. I guess few questions. Why is the ban lifted, number one? And the follow-up question is essentially, will it be the end of such policy, or is there a risk of future imposition? Or are there possibilities of different measures or method being introduced instead?
Morning, Suhaimi. So according to President Jokowi, the decision to lift the export ban on palm oil took into consideration the improvement of local supply of palm oil and prices, and the welfare of 17 million workers in the industry. The ban is to be lifted despite the bulk cooking oil price not reaching the targeted 14,000 rupiahs per litre price. In fact, the day before the announcement, the bulk cooking oil price in Indonesia was quoted at around 17,000 rupiah per litre, which is still 22% above the targeted price set by the government. So why is the government lifting the export ban barely a month after its implementation? I believe it is for the sake of smallholders who took to the streets to protest against this ban, which has hurt them the most. As reported in the media, the smallholders suffered big drop in FFB selling prices of up to 70% compared to before the ban. And not only did the price drop, some millers were even reluctant to buy their fruits, as they fear their storage tanks will soon overflow with no option to export. Meanwhile, domestic CPO price, not FFB, CPO price actually fell just 20% so far, because the large commercial growers have the ability to store CPO before becoming desperate sellers. Now, will it be the end of such policy? The answer is no, because the day after the announcement, the government reimposed DMO, or domestic market obligation. The government aims to maintain a domestic supply of 10 million tons of cooking oil. By our estimate, that amount is approximately 21% of this year's projected CPO output. And this is almost similar to the 20% DMO announced in January this year. Recall that the DMO was subsequently raised to 30% in March before scrapping it altogether in favor of higher export levies. Last Friday, the trade minister also said that it will determine the size of the DMO that must be met by each producer and the mechanism to produce and distribute cooking oil to the communities. So we shall await for more details in the coming days or weeks.
Right. Still a fair amount of policy uncertainty to affect CPO supplies and price. Zamros, on Philippines, the central bank raised interest rate by 25 bips to 2.25% last week. What prompted BSP to take the decision? What's our outlook on BSP interest rate outlook this year until next year? And aside from interest rate hikes, are there any other changes in BSP monetary policy measures that is happening and or coming?
Hi, morning, Suhaimi, morning, everyone. Yeah, BSP raised the policy rate by 25 basis point last week to 2.25%, mainly due to the both growth and inflation surprise on the upside, and also trying to anchor the inflation expectations. Growth for the first quarter was very impressive, 8.3% year on year, higher than the 7.8% posted in the fourth quarter last year, mainly because of the improved mobility and the reopening of the economy, which contributed to the unemployment rate fell to 5.8% in March from 6.4% in January and February this year. Hence, the growth in the first quarter was mainly driven by the domestic demand. And secondly, on inflation, inflation surged from 4% year on year in March to 4.9% in April. Hence, BSP is looking at the balance of risk leaning towards the upside for both this year and next year, mainly emanated from the higher or an elevated global crude oil price, hence contributing to the higher transport fares. And also, secondly, on the shortage of domestic pork and fish supply. And I think the decision by BSP last week, mainly also on the emergence of second-round effect from the higher than expected adjustment in minimum wage, especially in Metro Manila and Western Visayas. Hence, for this year, we maintain our outlook of BSP to raise the policy rate with total of 75 basis point to 2.75% by the end of this year, which means that we're expecting another 25 basis point rate hike in the third quarter, and followed by another 25 basis point in the fourth quarter. So with the strong economic activity and improved labor conditions, BSP has been rolling back its pandemic-induced interventions, which includes the reduced provisional advances to the national government, which already been settled on 20th of May. And also, secondly, given the ample liquidity, gradual recovery in credit activity, and stable financial market conditions, BSP also decided to reconfigure the government securities purchasing window from the crisis intervention measure into the regular liquidity facilities under the interest rate corridor framework. But I think most importantly, we expect the measures taken and upcoming by BSP will be gradual. It's going to be very much data dependent and baby steps progress so as not to interrupt the current recovery in economic growth in the Philippines right now.
Thanks, Zamros. From Philippines macro, let's move on to Philippines property. Sevidal, following recent presidential election, you maintain positive view on Philippines property sector. I mean, policy-wise, are there anything specific or anything to expect for the sector under the president-elect Marcos Jr.? And will the start of BSP interest rate hike be a dampener to the sector? Or is the sector's outlook driven more by structural factors?
Good morning, everyone. So I think in terms of policy, the only thing to expect really is taxation. Most of the key pieces of legislation have already been passed, such as the foreign ownership limit law, the Public Service Act. So these have already been passed by the outgoing administration. The only key, at least from a fiscal policy standpoint, the only key thing to watch out for is what they'll do with taxes. They will likely increase, and they will likely course that increase through indirect taxation, so namely value-added taxes. As far as the rate hikes are concerned, there are two things that are worth noting on that front. The first is that less than 30% of household purchases are done with credit or leverage. Most of it are done via cash or straight payment terms, albeit over an extended period of time, say in arrears. The other thing to note is that while the policy or the benchmark rate has gone up, what's remarkable is that the mortgage rates, at least what the mortgage rates that are outstanding on the market, they haven't moved up as much. So I think that that's an encouraging sign as far as being supportive of the sector. But ultimately, as we stress in our report, the drivers of the sector are ultimately structural in our view. There's still decent, actually robust growth that can be expected from provincial areas. That's compounded by the potential infrastructure pipeline that the new administration will inherit. Second, over the last 20 years, that's inclusive of multiple political administrations, land and property values have continuously appreciated. And then the third trend that we find encouraging is that the property companies are actually hiking their capital outlays, not just for this year, but also for the medium term, as seen in their fairly sizable pipeline for office, residential, and mall launches. So we think that the drivers are structural more than cyclical, hence our positive view.
Thanks, Sevidal. Interesting view or sharing about Philippines. Property purchase is not as leveraged like elsewhere in the region. Jean, C Limited share price have been bruised and battered, but is there any light at the end of the tunnel following the first quarter result? And overall, what's your recommendation to investors on stock in the tech space? Is it time to start bottom fishing or still too early?
Hi, good morning, Suhaimi. Thanks for the question. I just want to highlight, from the perspective of C and Grab, their first quarter net loss was better than our expectations. But to your question, whether this indicates that they're going to reach profitability, then we expect we don't think so. They'll probably still require a few years to reach break even. Yet at the same time, we are constructive towards C and Grab because they are regional champions in what they do. They have scale. They're able to hyper localize in this region where every country is very heterogeneous. And they have top of mind in the key areas that they operate in, and so this drives growth and also this drives their competitive position. So with this, we're pretty confident that they'll eventually reach profitability. I just want to add, one of the other key takeaway from the past two earnings seasons, it seems to be that both these companies are placing extra emphasis as they communicate to investors that they are judiciously managing resources. And my guess is that they understand that markets won't take too kindly to them if they try and fundraise now. Finally, on your question on bottom fishing, I think it's difficult to time the markets, but I just want to highlight that our valuation metrics for C and Grab, we don't think that they are very onerous, especially as compared to where things were last year. So for investors taking the long view and who believe in the company's competitive strengths and growth prospects, we believe that current levels are decent to gradually accumulate.
Thanks, Jean, on that advice to investors. Andy, on FX, I think a key recent development is declining Renminbi. What do past episodes of Renminbi weaknesses tell us, especially in terms of similarities and differences between then and now, and the impact to regional currencies? And what's your take on current Renminbi weakness and for that matter, overall FX market situation, bottoming or it's not over yet?
Hi, morning, Suhaimi. Yeah, so in all three episodes that we shared in the report, it occurred when China was experiencing a cyclical downturn. I think if you look at the OECD leading indicator for China, it flagged a peak in economic cycle months before. So all three periods, the OECD leading indicator for the world showed a downturn. In all three episodes, the equity bourses such as the CSI 300 also plunged at least 3 months before the CNY. So that's some similarities. However, there are significant differences in the three episodes. One is the solid current account balance for 2022. I think in 2022, first quarter, the numbers were quite robust compared to an average of just 9 billion over the period of 2018 to 2019. So rather healthy also for 2015 at around 57 billion. So a reason why CNY actually held up for around 13 months since the crash of the local bourses last year. But one major difference, I think, this time around is the portfolio outflows. It's been significant the last recent months, I think, for China. But I think Russia's sales of Renminbi assets due to the embargo on the US dollar and the euro-denominated portion of its FX reserves I think could have contributed to the portfolio outflow. So that's something that we're looking out for. The bulk of the portfolio outflows was driven by debt outflow. So I think in terms of the impact on regional FX, we found that I think the impact or sensitivity of renminbi to ASEAN currencies have actually moderated a bit. If you look at the impact of the past 3 episodes, in the past, the currencies that were most affected, subject to other external drivers like oil prices and plunge and slowing growth, ringgit was largely affected in 2015-2016 when the Shanghai sell-off, followed by Indian rupee and the Korean won and rupiah. In 2018, it was largely INR and rupiah. And then most recently, it has been Thai baht, Korean won, Taiwan dollar, rupee, and to some extent peso. But the sensitivity has actually fallen off. But in relation to your last question, in summary, we still think dollar CNY is still susceptible to two-way trades. I think the risk of persistent one-way move beyond 7-figure has actually reduced. If you can see, after the move last Friday, renminbi has actually strengthened. So it's reduced. China seems to have a fair chance of avoiding a Shanghai-like lockdown for another city. But recession fears for US actually might keep the USCH 10-year yield premium from widening and also reduce another bullish impetus for dollar CNY. But there are lingering risks that could keep dollar CNY supported for more infectious variants. I think that's one. The other thing is, I think we want to look out for sentiments. In our report, we highlighted that there could be other risks that could trigger contrary signals, and we need that to see what the signals will be. But until then, we interpret that the technicals as signs of potential bottoming in bearish sentiments is there for renminbi and also for some of the risks. But I think for now, any meaningful rebound will still need a positive fundamental driver. For now, we are actually lacking that. So I think we want to look out for that. And I think we shared some of the sort of signals or sign stops for you to look out for as a good indicator going forward. Suhaimi.
Right. Thanks, Andy, on that. That's it this morning. So wish everyone a good week ahead. Thanks.
For more advice, talk to your trading rep and check out market insights on the Maybank Trade app. Follow us on Spotify, Apple Podcasts or Google Podcasts and leave a rating. Happy investing. This is Noelle Lim for ASEAN Speaks by Maybank Investment Banking Group.